Okay, put together a tax plan, a brief tax plan. This is the first part of a tax plan. Actually, it is a tax projection. After the tax projection, then you can do other things such as create some strategies, look at some strategies. But this is the first part. So I just want to show you briefly how it works. If you'd like it, I'm going to share it. There's an input section and there's an output section. So you're only going to be able to input items in these cells over here. Here are a few comments and notes about some of the assumptions that we're doing. Filing status over here, drop down, either single, married, filing jointly, separately, head of household. When you click on this, you're going to see over here that the standard deduction, this is for 2023, the standard deduction is automatically going to be populated over here. Now, so that's that. W-2 wages, you're going to be estimating and putting in your numbers for 2023. So let's say you're making 100,000 W-2 wages, plug it in right there. So you're married, filing jointly. If this was only the only W-2 wages that you had, and this would include, I did not comment, put it over here, but this is going to include yourself and your spouses in the case of married, right? Hopefully that's self-explanatory, but maybe I'll put that in before I send this out. So this would be, if this is the only thing that was happening in your life, this is what your tax would be. Now, understand this is a rough estimate. There are a lot of assumptions here. This is straightforward, right? Just W-2. We're assuming, see this little asterisk right there, that there's no taxes paid. Usually with W-2 wages, taxes are paid. If you want to see what it would be like, essentially what you would have left to pay at the end of the year, if you are paying taxes with your W-2, just plug in the amount of taxes that you will have paid by the end of the year. So you can see that on your stub. Your check stub will have the amount to date. So there are ways of calculating it, but essentially that's the assumption over here with the W-2 wages. This is the gross number. Taxable interest, if you have any taxable interest or taxable dividends, let's say you have 2,000 taxable interest, 1,000 taxable dividends, right? Those are combined over here. Capital gain or loss, we're assuming short term right now. That's what we have in this model. Maybe a second model will add a feature to indicate if it's a long-term gain. But that's what this gain is over here. So if you have any short-term gains, plug it in over here, selling stocks, etc. Let's say you have a gain of, I don't know, $10,000. So now real estate designation, I'm going to leave that for a second. Essentially, you can either be, you don't, if you're not a realtor, oh, excuse me, you don't have to be a realtor, but if you are not a real estate professional for tax purposes, if you don't have any real estate, you just are going to ignore these two cells over here. Right? Let's leave those for now. Business income, if you have any business income, obviously all of these you only have to fill out to the degree that they apply to you. So if you have any business income, you're going to give the net of business income, and that specifically is for single member LLCs and sole proprietors. Any other types of business, such as partnerships and S corporations, any income K1s that you're going to be receiving, we're going to input them over here. But let's say net business income, you have, I don't know, you had a negative $10,000 in, well, let's make it a positive 10,000. Well, let's make it a different number. We already have 10,000 up there, $15,000, right? So here we see all these numbers are being added up over here. We have the W-2 income, taxable interest and dividends, capital gains and losses, other income, total income. This is your total income over here so far. So this also is automatically calculating your adjustments, AGI. This looks like it might be this is the QBI deduction. This is another adjustment to income. I don't recall exactly what this adjustment is right here. I have to look behind, but second. Yeah, so this right here, adjustment is 1/2 of self-employment income. Don't worry about it. It's just calculating in the background. Essentially, your self-employment, you're going to be paying self-employment taxes on this type of income. So it removes 1/2 of it for an adjustment at this point before calculating your AGI. Sounds confusing? It is. Don't worry about it. worry about it, but it's there are bigger fish to fry over here. So here we go. Income from a partnership. If you are a partner in a partnership, multi-member LLC, let's say you are able to get $7,000 in losses in the partnership, right? That is going to reduce your total income, as you can see. S corporation as well. Say you have a $17,000 K1, right? These are all the things that are happening over here. Now, this primary residence, all of these things over here have to do with your Schedule A, with whether or not the standard or itemized deduction will be preferable. So let's say that you own a home and you're paying mortgage interest expense. As long as these together add up to more than this 25,900 approximately, then it's going to switch and you're going to be using the max over here. Let's say it is 25,000 right here, mortgage interest, it's not going to change. And let's say here I pay $1,000 in property taxes. It's obviously not realistic, but then it's going to change to $26,000 because married filing jointly. However, for single, let's say if this is single, all the numbers are going to change now. Watch, for a lot of them, right? So single, because this over here changed, this standard deduction is $13,850. So this standard deduction changes. So that way, as long as these numbers over here are more than that, the $13,850, then it will automatically give you the itemized deduction. So let's say over here, I'm looking at 5,000, not going to change. Over here, look at 5,000 also. Over here, let's say we're looking at another 5,000. Now it's not going to be, excuse me, over here, 5,000 also. There we go. So the standard or itemized deduction is going to be right over there, $20,000. Now, that's that. Now, let's say, so that then it's going to calculate, this goes over here, adjustments to income. This is typically going to be the one half of self-employment income. You have AGI, which is your adjusted gross income. Then you have your standard or itemized deduction. Then you have your QBI deduction, which is essentially going to be 20% of your business income. And there's a calculation obviously behind it. Then you have the taxable income, which is 114. This is going to be essentially the combination of these items over here, which is the AGI minus some of these deductions. And then it calculates the tax based on 2023 numbers. And then you have self-employment taxes over here. So what you can do is you can literally just play around with this. And you can say, hey, how much should my wages be if you have any flexibility with some of these items, right? Do you take a capital gain this year or not, right? Let's say right now the tax is $23,351. That's a lot of tax, right? Let's say you say, you know what? I'm not going to get my capital gains right now. What's that going to do for your bottom line, right? It knocks off $3,000. Okay, something. What about if you are saying, hey, look, I have my business income. Maybe before the end of the year, I should make a purchase and bring this down to zero. Watch what's going to happen. Boom, knocks it down, another $4,000, right? If you're able to, so by looking at this tax projection, part A of the tax plan, by looking at this tax projection, you're able to plan. You're able to look. I think, you know, this is what I'm going to show you. Super fascinating over here. Watch. Net real estate income. Let's say, right, we all likely know about depreciation, real estate income. Let's say somebody has a $50,000 paper loss, right? $50,000 paper loss. Now, as soon as you use this one, you have to use this one too to make it accurate. Now, okay, the assumption is that that a real estate professional, that is what, that if there's nothing here, excuse me, then the calculation is for, excuse me, the calculation is for a real estate professional. Let's see if I'll edit that part out or not. But so a real estate professional, don't go into here. I have a video on YouTube, but I don't go into right here. Obviously, you know, there's not so much information about how to qualify as a real estate professional, but it is not what a lot of people think, that you have to be licensed as a realtor or anything like that. It's completely different. The tax designation as a real estate professional or not. And most people are active with the real estate, but again, there's also criteria for that. So you have to make sure you are active. Now, so this only considers whether you are active or a real estate professional, not if you are not active and not a real estate professional. So that's that. Now look what happens over here, right? There's right now we have $50,000 loss over here as an active real estate professional. And when we switch this up to real estate professional, you're able to take the entire $50,000 deduction, right? As an active professional, you can't take that entire $50,000. It's only $25,000 max that you're able to take. Now, also look over here. If I had, let's say, $200,000, look at what happens to my tax liability, right? And it's not just because of the increased W-2 wages. There's also a threshold over here that I'm not able to take. See, at this point right here, it doesn't matter. Second. So there's a small change over there when there is active Okay, so just to finish this up, capital gains or losses, let's say it's over here, real estate income, let's say you're negative 50,000, and let's say you were active. See, you really are not going to be able to take any of those losses, right? Look at this, negative 50,000, because your W-2 is too high. Let's say this was down to 100,000, then this is going to make an impact, right? This right here is going to give you more of a deduction, of a reduction in your total taxes. Watch this number down here. Without this $50,000 loss, you'd be paying $14,970 in taxes when your W-2 wages are at $100,000. When these are at $150,000, right? Then watch the total tax on the bottom, nothing, no change. $150,000 is the threshold. However, if you are looking at, let's say, over here, if you change this to real estate professional, watch what happens to the total tax, boom. You're able to take advantage of the full $50,000 real estate paper loss. Anyways, this is just a quick little, these things again. This is just a quick little plan that I put together. Beginning of the plan, you can change these numbers around as much as you like. I'll send it to you if you like. All right. Here's to reducing our taxes and having fun while we do it with nice, colorful inputs. Stop recording.